Hey guys, Chandra Shirshat here again. Today we're going to talk about advanced strategies in options trading. Before we start, of course, we start with the disclaimer. I am in no way a certified financial advisor or an expert or claim to be an expert in these areas being discussed. This uh, s- this seminar is purely educational, and any loss or gains that you incur based on watching the session is purely your responsibility. And in this video I'm gonna have a lot of demos, as in examples, real life examples. Just note that those are for demo purposes only, and do not place trades based on those examples. Please do your own research before placing any orders. So what's the agenda for today? We'll talk about some of the simple strategies, then get into some of the advanced strategies, and get into deep dive into a couple of strategies. There are a lot of strategies, as I discussed in the previous video. There are a lot of strategies. We're not going to jump into all of them, but focus on a couple of strategies that have been working for me. So hopefully they will work for you as well. Okay, so what are the prerequisites? You must have a good understanding of stock trading, of course, and if you do not have your fundamentals squared out about stock trading, I have made a video for that called Just Basics Stock Trading. Please watch that one. And for this one, you got to have a good understanding on option trading as well. And for that, I have introductions to option trading, um, another video that I made before making this video. So please go ahead and watch those two videos. Those will help you set the foundation for this one. And what else is needed? You need a growth mindset. What is a growth mindset? There's a book for it. So book called Mindset by Carol Dwight. So it's a great book. You want to have a growth mindset and not a fixed mindset, which is very important for many other things, to be successful in life, not just in options trading. So I highly recommend that book called Mindset. What else do you need? You need to have willingness to learn. These are some intricate strategies. You need to invest some time and be willing to learn difficult concepts. They're not that difficult, but you still have to spend some time to understand how those things work. And of course, as in any trading, stock trading, options trading, or any other trading, you need a lot of patience to be successful. All right, let's talk about simple strategies. I talked about these in my previous video, so I'm not going to spend a lot of time here on just buying and calling, buying calls or puts. Of course, we have maximum loss is known, how much we're going to lose. As in these examples, your loss is going to be $200, and the upside potential is unlimited. However, I got some feedback from some of the people who watched my previous video, and I heard that hey, it's not working very well for us. Most of the time, either we lose the premium that we paid, the $200 that we paid, or we just barely made it, and maybe $40-50 more. So we are hardly making any money out of all the investment that we made and the time we spent. That was expected. Let's jump in here. Why does this not work? Why does it not work? Why just buy the pull calls and pulls and puts and then make a lot of money? Um, that's because the main reason for that is expected move is already priced in. If you think that you're going to buy a call because the stock is going to move up, but guess what? You are not the only one to know that. So if Amazon is going to go up because of earnings that is making tons of money, you're not the only one to know. Everyone else in the market knows that. So the options already price that in. They factor that thing and already factor that in the price. So let's look at the example of. I took a classic example of Tesla because it's highly volatile. Because one day it jumps. Look at this one. On Friday, it dropped 10% or more than 10%. $80 it dropped, and then on Monday it might jump $80 or $100. It's this is one stock that moves in a huge manner. 30 $40 is nothing. 30 points, 40 points is nothing for it to move in a day. It moves in 50s and hundreds of points, 80s, like tens of percentages. So if you look at, let's say, Elon Musk already tweeted, right? So he tweeted that, hey, this is Tesla price is, or Tesla, in my opinion, is highly overpriced. So that means the stock is going to drop. It already dropped 10%, and I, let's say we all believe, and maybe it's a, we can even predict that it's going to go down to 600. So if so, in 1 week, in one day, it dropped $80. So in another week, definitely it's going to go to 600. Let's say it's going to drop another $100 coming week. So based on that, I want to place a trade. I want to buy a put for $650 so that I can make some money when it goes down to 600. Look at the price you're going to pay for it. 1974, almost $20. In fact, the ask price is already $20. So you're going to pay $20. That means if the stock price goes down to 600, you're going to make a profit of $30. 30 times 100 is $3,000. Yes, but only if it goes to 600. What if it stays around here, somewhere in between, it stays around 650? Even if it comes down by 50 points, you're going to make nothing. You lose your $2,000. Um, here is a here is the detail, quote detail from I use Interactive Brokers. This is a risk to return ratio and profit probability of making any money in this trade by buying a put for 650. May 8th, I'm just talking about 1 week here, uh, just 5 days. The profit probability is 21%. There is a 21% probability of you making any money, $1 even. um, a max profit of 2000, maximum loss is $2,000. Let's say if the stock doesn't go anywhere, or if even if it goes down only by 50 points, you're going to lose your $2,000 premium that you paid. And the max return is 62 965. That's like Tesla stock going down to zero by May 8th. The chances are very, very, very slim, if at all it's going to happen. So um, just buying call or puts is, the chances of winning is fairly low, I would say, like 21% in this case. So let's see what else we can do. The other thing we talked about, pretty simple strategy, which is selling covered calls and or selling naked puts or cash secured put selling is what we talked about in the previous video. Go back and refer to them if you want to. But these, I would highly recommend doing those only if you are going to use limit orders to buy or sell underlying asset. If you are trying to generate income, like I tried to do it, this is what is going to happen. These are real life examples. This is what happened to me. So um, uh, this is Facebook. Facebook dropped like a rock. We all know that everything, all stocks dropped like rock, and they came down to the bottom. So from around 220 or 230 or 225 ish, it came all the way down to 150. So in this, and it started moving up a little bit here. Uh, and around here, I thought that the stock price was around 165. I sold. I said like, okay, well, the recovery is done. It's the this is a big drop here where coronavirus brought everything down. So and then market recovered a little bit, and I thought that okay, this is a short-term recovery, and it's Facebook has come up fine. 150 was too low. 160 is about right. 180, I don't think it'll go. Let's generate some income. I sold some covered calls. May 15th covered calls for with a strike price of 180, and look what happened. So I'm gonna, if this is today, or today it's about 202. If the stock price does not come down anymore, I'm going to sell this stock, even let's say even if the stock is at $200, I'm going to sell it at 180. So I'm losing money on the covered call. Let's see what happens on naked put. Something similar happened here. This was pre-coronavirus. I had sold cash secured puts for Schlumberger. Schlumberger had dropped from around $40 to about $35, and I thought $35 or even less than $34. I said like, oh, this is a big drop, doesn't make sense to me. when I did my research, I did do my research and found that Schlumberger is worth at least $40 in the long run. I said, okay, fine. May 15th, I'm going to sell some, not in May 15th, around May 8th or something, May 9th. May 9th or so I said, like, for May 9th expiration date, I'm going to sell puts for $30. It's not going to drop. It's already dropped from 40 to 35 or 34. It's not going to drop to 30. That was my hope. And guess what? This happened. What is this? It's a black swan. What is black swan? There is a book for it. This is a very good book. I highly recommend reading that one. It's called Black Swan. um, Black swans are rare. Usually we all believe that swans are all white, right? Once in a while we do sight black swans, very very rare. And it's basically, what black swan is, a rare event such as coronavirus or the 9/11. When those happen, market drops like this. And I was not aware of this one. The um, uh, whole world getting shut down and oil price plummeting to negative. Oil was selling for a negative price, so I didn't know about all those things. And I was hoping that the Schlumberger will go back to 40, and it didn't do that. And I got assigned a large number of stocks. I bet huge on that one. I get a lot of Schlumberger at 30, and the price of Schlumberger now is about 15. So I'm down 50% on that. So naked puts are great. You can generate some cash with that, with them. But once in a while, be ready to get large amount of stocks assigned. So you should have, obviously, you must be doing cash covered put. Otherwise, you'll be losing a lot of money. Okay, let's jump into some advanced strategies. Um, I don't think we talked about this one in the last video. So let's talk about bull call spread. Um, what's bull call spread? So bull, by its as it indicates, bull means you're bullish. The strategy is a bullish strategy. Um, this is slightly better than just buying calls. So instead of just buying calls, buy a bull call spread. What is the intention of using this spread? Um, let's say you are bullish on Amazon. Pardon me. You're bullish on Amazon. You think that by July, Amazon is going to go up. But at the same time, you don't think Amazon is going to go beyond 2,500. Maybe it'll go up to 24, 23, 20. It's at about 2270 now. It'll go up to 2450, and that's about it. Maybe just barely touch 2500. But it's not going to go beyond that. 2700 is ruled out. That's your or my theory, and that's what I'm betting for. So in that case, I don't want to just buy a call. If I buy a call, I'm going to pay 177. That means 17,760 is what I have to pay for a um, 2250 call. So instead, what I want to do is I want to buy this call, but sell the 2500 call. So when I sell this, I get money. I get 71 back. I pay 177. I get 71 back. My cost is going to be about 105 or 10,500. So instead of 17,000, I am spending only 10,000. And the maximum return is not infinite. In case of, if you buy a call, your um, upside potential is infinity, but that's never going to happen. Amazon is never going to go to infinity. So you know that, and you are betting that it will go up to 2,500, maybe just a little more or a little less, but around 2,500 is what you think it's going to be in on the expiration date of July 17th. So you bet this one. Your upside potential is 14,458. Downside is 10,500. Profit probability. Look at this one. Profit probability. Earlier we were looking at profit probability at 21. Now the probability has gone up a little bit. And minimum investment is this. This is risk to return ratio. Of course, this is great. This is better than the previous one, but I am still not happy. Let's look at if we can do something better. Okay, so that was bull call spread. There are bull call spread is one of the vertical spreads, but there are other vertical spreads such as bull put spread, bear call spread, and bear put spread. And I would like you to go ahead and figure that out yourselves. That's your homework. And then there are other strategies. There are straddles and strangles. The strangle is especially um, important for us for today's discussion. This is kind of something that I like very much. Strangles are what I like, especially the short strangles. We'll discuss them in the coming slides. There are butterflies. Again, butterflies are something which involves multiple options trading to reduce the risk of options that you're trading. There are ratio spreads where you buy one one is to two, two is to three. Basically, you're buying one call, selling two puts, or vice versa. So those are ratio spreads. Calendar spreads are you buy a put for a particular month and you sell for another month. So you're spreading your purchase and sale of options on different expiration dates. That's why it's called a calendar spread. Collars. So this is another interesting strategy. So this is a some of you guys can use this, especially those who own a lot of stock of a particular um, asset, of a particular instrument. Let's say you own a lot of Apple stock because you're an employee of Apple, or you own Amazon stocks because Amazon, you're an employee of Amazon, you got a lot of Amazon stocks, or just because you purchased them. And now you are at a point here where the stock is about to pull back. The market is going to pull back, and you're worried about market pulling back, and you want to protect those assets. Collar is a good one. In collar, what happens is you sell a call and you buy a put. You sell a call saying that that's a covered call. Basically, you sell the covered call saying that market is not going to go up, but you're afraid of market going down, but you don't want to just buy a put because it's going to cost you a lot of money. You don't want to lose that money, but at the same time you can raise some funds by selling calls and use those funds to buy your put. So um, net out of your pocket is zero on these collars, but then it's going to protect you from the downside. If Apple or Amazon or whatever asset is going to drop like a rock, you're going to be protected with collars. So go ahead and check that out if you own a lot of stocks of a particular financial asset. And again, to know more about these strategies, I that's going to be your homework. Go figure them out. How are you going to figure them out? Here are the resources. I'm not going to spend a lot of time on every single strategy out there because it doesn't make sense. Those videos are already out there. So go ahead and learn those strategies. So some of these are very interesting. I watched all of these before making this video, by the way. So go ahead and Google CME option strategies. You're going to learn more about the butterflies and straddles, strangles, and everything. So and then options forum, E-Trade options forum is a good one. They have foundational videos and advanced videos. In advanced videos they're going to talk about iron condor, which I'm going to discuss today. And basically I got my idea of doing iron condor from E-Trade. So I'm going to share that with you, what I am doing, and then you guys can watch the videos there as well and understand better, both from me as well as from the E-Trade videos. Investopedia obviously has a lot of option strategies explained with videos as well as articles. So read the article, watch the video, do all this multiple times until you get a hang of every single strategy um, out there. And then you will be able to make up your own strategy, or depending on the market condition or the momentum of, or whatever the asset that you're trading, based on what you think it's going to do, maybe bullish, bearish, or neutral, you can pick those strategies and make money out of it. Moving along, let's get into this important thing. So we're going to deep dive into some of the strategies that I believe is ideal for today's market. So what is today's market? Today's market, in my opinion, I don't know. It's really hard to say whether the market is going to go up tomorrow or market is going to go down tomorrow. So since February, we are seeing this high volatility in the market. The market dropped like a rock from here all the way down here, and then we thought that it's going to stagnate here. At least I thought it was going to stagnate. It's not going to jump, but it made a V V-shaped recovery. That's a huge recovery. It's almost back to, it's not quite back all the way to the top, but it's almost there. Maybe another 10% down, that's all. But that's a huge V-shaped recovery, which I did not expect. And now what's market is going to do next? I have no idea. It's probably going to drop again, or it may go up again. Yeah. But one thing I'm certain of is volatility. The market is going to be highly volatile. What does that mean to us? High volatility means it's good for people who are selling options. The option prices are going to be very high. They're expensive. So our strategy should not be buy call put buy puts, because those we're going to pay, as you saw the Tesla's one, $20, $2,000 for an option. That is like, even though it's $50 away, it's almost like 10% down. It's still like going to cost you $2,000. So options are very, very highly priced. So what can we do? We want to make money by selling it. So some people say that, hey, options trading is like gambling, man. You're literally gambling. I say, yeah, sure. You want to call it gambling? Fair enough. You call it gambling. But what happens in gambling? You go to Las Vegas, you sit on a table, you are in no you are in a pathetic state. Your probability odds are highly against you. The house is sitting with a probability of 80, and you are sitting there with your money at with 20% probability, or even less. I think some of the tables out there have probability of, you know, 1 is to, or maybe 5%. The slots are horrible. The odds of winning are so low there. You might win big lightning strikes and then you make a lot of money, but the odds of winning are very, very, very slim. But here, this is different. The tables are out there. You can be the house. You can define your probability however you want. So I would not call options trading as gambling, but I would say it's a game of probability. As we saw in the previous example, buying calls and puts, I showed you an example, 21% probability of winning. And then we talked about bull call spread. Our probability went up 45%, something like that. And then now what we want to do in options trading is we increase our probability. The win rate has to be higher. The probability of winning should be high. We should have an edge over the market. So that means you are like the house, and the other people who are buying options, or buying or selling options, they are you are the casino, and they are the patterns. So that's what we want to be here. We want to increase our odds of winning. We want a very high probability, close to like about 95. That's what I like. I want like 99% probability of winning. Let's look at them. We have options like that, or strategies like that, where win rate is so high that even if you lose, that's fine. 1 out of 10 times you lose, 9 times you're going to win. You'll be just fine. So let's get there with this strategies for today's market. Before we get into the strategies for today's market, I would like to understand, as I said before, strangle is very interesting concept, and I liked it right from the beginning when I watched the video first time. Especially the short strangle. You don't want to do a long strangle in this market. It's not going to do anything for you. You're going to lose money. So short strangle is where you get the money, you get credit into your account. Um, so what we are doing here, this is a neutral strategy. And I like neutral strategy in today's market because I have no idea. I don't want to predict whether Tesla is going to be up tomorrow or down tomorrow. It doesn't matter which way it goes. I want to make money. That's my motto. I want it to be highly volatile, so the option prices are high. I want it to be in a certain range. That's important. So that's the only key for me, is it has to be in a certain range, and I'll make a lot of money. But I may still lose, but I want to increase my odds of winning. So let's look at this one. So what is short strangle? You sell out the money put. You sell a put. So that's your you can see that it's just take put selling and call selling, and then you put them together. One is this and one is this. You join them together, it becomes the short strangle. So what's your maximum profit? It's you're selling put, so you're going to get some money by selling put. You're selling out the money call, you're going to get some money for that, and the sum of that is, in this case, it's going to be 1700. 1700 is your maximum return, okay, because you sold a call and a put, both of them out the money. You sold 600 put, 800 call, and the Tesla stock is right at around $700. The underlying price is 701. The closing price was 701.53. That's the current price. So you're saying that Tesla will, this is May 8th, by the way. This is May 8th. That's like exactly 1 week. In 1 week, you're saying that Tesla will not go below 600 and Tesla will not go above 800. As long as it stays within that band, you are going to make $1,700. Pretty cool, huh? And the same expiration date. But however, maximum loss is infinity. I ain't doing it. Black Swan. Black Swan comes here again. Why does the Black Swan come here again? Because it's Tesla. 600, it may go to 400, 300. I don't know. That's what the Black Swan means. Um, extremistan. If you listen to the book, in the author talks about extremistan. Every once in a while, extreme things happen. So I do not like the fact that the maximum loss is infinity. The stock may go to $2,000. If it goes to $2,000, here is how it is. If the market moves 10% down, I'm going to keep my 1,700. Anywhere from -10 to my +10, I'm going to keep this. But if the market moves 20% down, which is possible, by the way, this is Tesla, and you're going to lose $2,000. What if the market moves 30% down? I'm going to lose close to $10,000. And same thing here. The market moves up 30, or if Tesla moves up 30% up, I'm going to lose close to $10,000. I don't want to do that. Let's see what we can do here. Even though by the way, we should look at the profit probability here. Look at the probability. We with the call or a put, it was 22% or something like that. With a bear call spread, we went up to 45. Look at the short strangle. The probability of making any profit is 80%. 80%. That's pretty good. But I still don't like it. The maximum loss is still 1%, less than 1%. It's already a small fraction of it. But I still don't want to do it. I ain't doing it because this 1% can burn me real bad. So I ain't doing it. But the chance of make maximum return of 1,700, the chance of making that is 72%. Pretty impressive, by the way. um, you, I mean, people do this, and they don't lose a lot of money, because even if it moves 20% in 1 week, they might lose $2,000. If they're okay with it, they're ready to take $1,700. Okay, let's move on to iron condors. Okay, so we already moved up. Sorry. All right, so iron condors. So what is an iron condor? Iron condor is the same. As you can see the graph here, um, it's the same graph, short strangle. But then what I'm doing is I'm limiting my loss here. Only thing that I'm doing here is cutting these legs. These legs were too long. I didn't like the fact that they were too long here. They were going all the way down here forever. I didn't like that, so I cut those legs. That's iron condor. Again, the strategy is neutral. One thing that I'm going to do is I'm going to sell out the money put. I'm going to sell out the money call. But then further out, another $100, I'm going to buy a put. So I'm going to, instead of 1,700, I'm going to make only 1,200. But then there's no infinity here anymore. It's not infinity anymore. It's only the max loss for me is 8,798. I'm not going to lose more than 9,000. That gives me a lot more comfort than infinity. I don't like to see infinity down here, max loss. The profit probability went down a little bit, from 80 to 78, because I'm paying a little bit of a premium to do this business here to save myself from the black swan events. Max return, 72% chance, still not too bad. And max loss, per chance of max loss is very, very less, 3.5. I'm ready to take that chance. um, okay, so this is something that I am doing it. One thing that you need to understand, when do you want to do it? When do I do it? I like to do this when the volatility is very high and I know that the volatility is going to come down in the coming weeks or coming days. The perfect timing for doing this is just before the earnings. So for example, Tulio is reporting next week, the upcoming week. So it's a perfect thing to do for Tulio. What usually happens is just before the earnings, volatility is very high because everybody is like, oh, there is an anticipation. Is Twilio going to do well? Is Amazon going to do well? Is Amazon going to pull back? Nobody knows. Everybody's in suspense. Everybody's betting one way or the other. So the implied volatility is very high. Um, and then what happens when the earnings comes out? It's diffuses. Everybody knows what happened, what's going to happen, because Amazon said like, okay, I'm going to make $4 billion, but then I'm going to spend it all on coronavirus, and the stock pulled back. But this week, the volatility, if you go back and go and look at the volume, it would have dropped. Volume on the trades, everybody betting this way, one way or the other, they all pull back and say that, okay, fine, I know what's going to happen with Amazon. It's a long term, maybe it's a long term buy, but right now it's not going to play out like I thought it would. I thought it would go to 2,700 or 3,000, and it ain't going to happen. And it's not it's going to pull back to 1,800. Probably not. I mean, their report was not too bad, so it's probably going to flatten out a little bit. Maybe um, still volatile, but not as volatile as I expected it to be. So that's when wall crush happens. What is wall crush? Volatility crush. Volatility was this high, and it crushed and came down all the way down here. So when the volatility was high, you put this iron condor, you bought this iron condor, and you got $1,200. And when the volatility has dropped, you're gonna the 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 cost of options will come down, and you're gonna make some money there. So iron condors, you should benefit from wall crush. Okay, calendar spreads. We talked about calendar spreads. I'm not going to get into the calendar spreads in general, because you can go get that information from some of the videos out there. But I'm going to talk about the version that I am working on, that I use for my own purposes. What I do is if I believe, if I'm bearish, this is a long-term bearish. If I'm long-term bearish, I'm going to use this. Um, if I'm bearish on Tesla, for example, I'm going to say that Tesla went to 850 or something, and I don't as Elon Musk confirmed, I didn't believe it was going to be that much. It was not supposed to be that much. I believe it's more around $400 worth, or even less than that. So I bought August expiration, um, 400 400 put for about $22.30. That's a lot of money. That's about $2,000, but that's fine. I don't know if the Tesla keeps moving down, I'll make money. If it doesn't, then I'm going to lose it. So if it stays um, around 700, I'm not going to make much money there. What I'm doing instead is on a weekly. So this is August, way out there, several weeks, like for May, June, July, August. So that's about 3 4 12, about 15, 14 15 weeks are there, at least more than a dozen weeks are there. So I'm going to um, I sold a put for the 400 strike price for May. I haven't sold it, but I would do this for about $1.30. So my cost came down from 20 to 30 to about $21. The next week, I'm going to repeat this again. Every week, I'm going to sell more, 400. If it keeps dropping, I keep making more than 1.3. If it goes up, I'll not make 1.3, but I'll make $200-300. That's fine too. Whatever I make, I keep reducing my cost here. Instead of 22.30, my cost of the put keeps dropping every week. Depending on if the stock of Tesla keeps moving down, and this becomes more valuable as well, this 22 becomes more and more valuable, and I'm collecting the premium on the downside as well. So that's what I'm doing. I repeat every week. I keep selling the strike price, 400 strike price, every week. All right, you can also try this if you are comfortable with it. Okay, so what are some of the things that I use to do the research? So you need tools, obviously, to get those percentages and out there. I use something called the bar chart. So this is a pretty good one. Barchart.com. I'm a premium member. Um, it gives me various um, strategies. So naked puts, for example, if I want to sell puts, so I go here. I have just click on naked puts. It brings up this screen here. Shows me I can set my own filters if I want, but I already have some uh, saved screeners. short term. Usually I want it like less than a couple of weeks. I'm only interested in short term. I don't want to bet anything longer than a few weeks. So I want to, for next week, if I want to bet, I can sort it by annual return. So look at this one. If I, this is uh, Hertz. Hertz already dropped a lot here. It's $3. And if I want to sell a naked put on this one, or cash secured naked put, um, cash secured put, if I want to put for $3, I'm going to get 65 cents uh, per sheet. I'll get $65, and the break even is 49%, and annual return would be like 1500. Pretty impressive. I can use this. I do use this sometimes. I do place these orders sometimes because these are too impressive, but the chances of these winning is not always that great. Um, but let's look at some of the. Similarly, you get bear call spread ideas, bull call spread ideas, and so on. I don't use. I'm not doing bull call or bear call spreads that much. I don't like them as much in this kind of market because the cost is going to be very high, and I really don't know which way the market is going to go. I'll be very honest with you on that one. So, but I do like short strangles. Let's look at short strangles for the next week. I don't have anything saved, but here's what I'm going to do. I want days to expiry only about 10 days and see the results. All right, 5-8 Zynga. I can place. Um, this is a short strangle, by the way. Bar chart is giving me short strangle, but I go ahead and convert them to iron condor because all I do is they give me the two sell options. I have to sell 9 call and 6.5 put, and look at the probability of winning here, 99.3. I like this. The probability of winning is 99.3, but I still don't want to place a uh, do a short strangle. Instead of short strangle, I would still convert this into an iron condor to protect myself from the black swan events if it all is going to happen. Piton is a good one. But look at the amount. Piton is reporting next week, so this is the volatility is going to be high after the earnings report is done. The volatility is going to crash, so this is a good one. I would put an iron quarter on this as well. So the chance of winning is 98%. It's not bad. I would usually stay in the top here and not go below 95 unless I know the stock very well. I did do a iron condor for Amazon. It worked out very well for me. That was before the earnings. It did give me some heartburn. I was nervous for a bit. What if Amazon jumped to 2,700? Uh, so or 2,800 or something like that. Some people were predicting, were anticipating that kind of move, but I took some risk. Um, the risk was pretty high actually, about $10,000, and the risk was higher than the return actually. The risk was about $9 or $10,000, and the expected return was $5,000. Um, I didn't wait until the end. 5,500 was the or close to 6,000 was the expected profit, but on the last day, I did not want to wait until the close because it was the Amazon dropped too low, and it was coming close to my limit. So I did close it before the expiration. I didn't make all the profit, but I made decent amount of money. So iron condors work very well. Have been working out for me, but they are not risk free. Nothing is risk free, but the chances of winning must be higher. Look for the probability of winning. Um, the other tool that I use here is my your brokerage firms. Whatever brokerage that you use. I use interactive brokerage, and they have something called trader workstation. I can go ahead and put, like, let's say Tesla, and I can do combinations. I can do option combos. I want to do option combos. Hang on there. Still working. There you go. All right. So here I can decide to do whatever I want. So if I, in the strategy section, I can pull it down and look at all the various strategies that it gives me. Um, all of those strategies that you want to use. Um, as I said, I haven't used any of these. I have used pretty much. Strangle. I don't want to use because iron counter is my strangle. I have used vertical spreads, that bull call spread and all those. Um, and the only other thing I do is iron counter. So let's do an iron counter. So let's Tesla expiry date May 8th, and let's say the Tesla is going to pull back to 600. This is the example that I showed you earlier. So I'll do 500 here, and then I'll do 600 here, and I'm going to do, it's at 700, so I'm going to make it 800 here and 900. So I'm buying 500 May put, selling 600 May put, selling um, 800 May call, and buying 900 May call. Now all I have to do is click add here, and here you go. I want to now see what my performance profile is. So this is an important thing I look at. So 72% chance of winning, 3.5% chance of the same thing that we saw earlier. So what's going to happen on May 8th? So I'm not going to spend all that time here. Coming back to this, other things that I use is E-Trade. They have similar strategies where you can place orders and stuff like that. I bet some of the other brokerage firms, TD Waterhouse, and some of the other ones like that you may be using also have similar concept of selecting a strategy and looking at the performance profile, what are the chances of winning, and so on. Go check those out. But I personally use E-Trade and Interactive Brokers. I have both accounts on both sides. Zax.com, I use that for research. Uh, Zax has he has Zax provides some ratings, 1 to 5 or ABCD or something like that, some ratings. Based on that, you can say that whether it is a good stock or not, long term and not. So that's a useful website, but there are many more. I use MarketWatch, Yahoo Finance, and so on. With that, I say good luck. I hope this presentation was useful for you. Um, Again, options can be risky, but if you are an educated investor, if you know what you're doing, and if you are careful, they can be extremely safe, and you can make a lot of money. And last but not least, I want to leave you with these organizations. I would greatly appreciate if, especially if you make money with these strategies, don't forget to be good and support some of these organizations. Lava May, Direct Relief. These are um, US based organizations providing relief not only in US but around in many other countries as well. IDRF is for India Development and Relief. Seva International is actually providing services in multiple countries, hundreds of countries over the world to support these organizations. Once again, thank you very much for watching my video. Please do subscribe to my channel and hit the like button. And the next uh, thing on my mind is algo trading. I want to explore that. I haven't spent much on time on that one. Algo trading is basically you write a computer program that is going to place orders for you. I want to see if I can I can write an algorithm, a computer program that's going to put, not maybe iron counter is a little too much, but maybe it can do my put selling strategy, buy a long-term put and keep selling puts against it. If I can automate that process, I don't have to worry about it. So that's my one of the other things, one of the things I want to do. And on the basic side, maybe I will do a just basics on economics. People talk about economics a lot, but not many know what the basics of economics are. So we'll do those videos in the coming months or weeks. So stay tuned. Thank you.